The Globe and Mail ran a story recently that genuinely rattled people across the country. It reported that Canada's GDP per capita has fallen behind Alabama's. Alabama is one of the poorest states in the US. A lot of people pushed back on the comparison. They said GDP per capita is a flawed metric. They said it doesn't tell the whole story, and technically they're not wrong. But here's one thing: the debate about whether the metric is perfect is the wrong conversation to be having, really, because the data underneath it is pointing at something else, something that most Canadians are already feeling but can't quite put into words. Canada's economy keeps growing on paper, and yet somehow most of us feel like we're falling behind. That feeling isn't in your head, and the numbers back it up. If you've been feeling the same way, please let me know your thoughts below in the comments. But let's start with the comparison that actually matters, and it's not necessarily Alabama. From 2014 to 2024, Canada's real GDP per capita, that's the gross domestic product, adjusted for purchasing power, grew by a total of 3.2% over 10 years. That works out to about 0.4% per year, and it ranked third lowest among 38 advanced nations. Over the same period, the US grew by 20.2%. The OECD average was 15.3. Canada grew at roughly one-fifth the pace of the US and less than a quarter of the OECD average. You can't blame the gap on how you measure the numbers. That's a real divergence. And it's been getting worse. In 2014, Canada's GDP per capita was 83% of America's. By 2024, it had dropped to 71%. We lost 12 percentage points of ground against the US just in a decade. Even more telling is Canada's GDP per capita has now fallen below the OECD average for the first time in recorded history. We used to be comfortably above average among developed nations, and now we're not. Canada ranks 19th out of 38 OECD countries, and we are sliding. The OECD is the Organization for Economic Cooperation and Development. It's an international organization of 38 member countries, like I mentioned, committed to democracy and the market environment. They're headquartered in Paris. And this is where it gets harder to ignore. People who push back on GDP per capita will say, fine, but look at quality of life instead. Look at happiness, look at health, look at equality. Fair enough, we can do that. I think that most people would feel like that's been on the decline in Canada. Canada's ranking on the United Nations Human Development Index dropped from 13th in 2013 to 16th in 2023. The World Happiness Report has Canada falling from 5th place in 2012 all the way down to 25th place in 2026. That's a massive drop. And the number inside that happiness data that should alarm every Canadian: young people under 25 in this country rank 71st globally in happiness. The rest of the Canadian population ranks 24th, probably because we remember a happier time. 71st for young Canadians, though. That's not a rounding error. That is a generation telling you through data that something is seriously wrong with the deal that they've been handed. Food bank visits have more than doubled since 2019. Over 2.2 million Canadians visited a food bank in March 2025 alone. Healthcare wait times hit 28.6 weeks in 2025, the second longest ever recorded in this country. These are not abstract economic stats. These are lived experiences of Canadians getting worse across almost every metric that matters to people every day. And listen, I'm not all doom and gloom. That's not at all where I'm coming from. We live in a great country still. We are lucky to have healthcare and things like that. But there's definitely been a decline in the general well-being of Canadians, and the numbers are showing it. Now, here's an argument you'll hear sometimes. Canada made a choice. We traded some economic growth for a more equal society, lower incomes, but shared more fairly. The data does not support that. Even the OECD countries right now achieve both higher GDP per capita and greater income equality than Canada. Not one or the other. They have both. Norway sits at 71,000 GDP per capita and is more equal than Canada. Denmark is at 68,000, Sweden at 60,000. Germany is at 61,000, and virtually identical income distribution to Canada. Canada's GDP per capita is around 52,000, and our equality ranking is middling. It's not exceptional. We're not the country that traded growth for equality. We are a country that got less of both. We fell behind in prosperity without any meaningful improvement in how that prosperity is shared. This is the part that should make Canadians upset. Here's something that almost never gets talked about, and it really matters. Even the weak GDP per capita numbers Canada is posting now might be overstating how healthy the economy actually is. Here's why. The government spending as a share of Canada's GDP went from about 38% in 2014 to 45% in 2024. A significant chunk of that increase was funded through deficits, meaning borrowed money. The way GDP accounting works, government spending counts as economic output regardless of whether it comes from tax revenue or debt. So when the government spends more borrowed money, the GDP number goes up even if the underlying private sector is struggling. Economists call this a fiscal mirage. The headline numbers look okay, but strip out the government spending propped up by deficits, and what's left is a private sector that has been contracting in real terms. And here's the problem with that productivity growth, the kind that actually raises wages and living standards in a sustainable way, comes from the private sector. It comes from businesses investing in better tools, better technology, and better processes. Government spending can fill gaps, but it doesn't drive long term prosperity. We've been papering over a private sector decline with public debt, and that bill is coming due. This is the real story underneath all of it, the thing that actually explains why Canada is falling behind. Business investment per worker in Canada has been declining for decades. Canada's stock of machinery and equipment is shrinking. Canadian businesses today are operating with less physical capital per worker than they had 10 years ago. Canada spends 1.1% of GDP on business research and development. The OECD average is 2%. We're investing half of what our peers invest in the innovation that creates future growth. Venture capital, which is the money that funds startups and new companies, is falling as a share of GDP. And the funding that does exist increasingly pushes Canadian entrepreneurs to scale their companies to the US, not here. Think about what that means practically. A Canadian starts a company, gets some funding, and then has to move it south of the border to access the capital and market that it needs to grow. We are growing the seeds and then watching someone else harvest them. The GDP per capita decline is the symptom. The investment collapse is the disease. And until Canada can figure out why businesses are not investing here at the levels they should, and fixes it, the numbers are going to keep moving in the wrong direction. So, to bring it down to earth, what does this mean for someone living in Hamilton or Toronto or Canada right now? It means the reason it feels harder to get ahead than it used to is not because you're doing something wrong. It's because the economic system around you has genuinely been producing less real value per person for a decade. It means that when you look at your parents and what they were able to afford versus what you can afford now, that gap is real. It means the young people leaving this country, the ones I talked about in a recent video I did, 106,000 of them in 2024 alone, are not being dramatic. The math actually works for them in a way it doesn't here anymore. And for real estate specifically, here's the direct connection. When per capita income stagnates and real purchasing power erodes, housing demand softens even if prices are sticky. That's what's happening right now. This is part of what we're seeing in the markets like Hamilton and Toronto. Buyers are not just cautious because of interest rates. They're cautious because their real financial capacity has been quietly shrinking for years. So, understanding that context does not tell you exactly when to buy or sell by any means, but it does tell you that the current market is not just a blip. It's connected to something bigger that's happening in Canada's economy. So the bottom line, Canada's economy has been growing. The headline numbers say so, but the growth has been increasingly propped up by government spending funded by debt. While the private sector contracted, investment collapsed, and the average Canadian fell further behind their peers in other developed countries. We're not choosing equality over growth, we're getting less of both. And the people who feel it most are the younger Canadians. 71st in happiness globally, priced out of housing, watching the math work better somewhere else. This is not a sustainable path for this country, and acknowledging it is the starting point to changing it. If you're buying or selling in Hamilton and want to talk about how this affects your specific situation, feel free to reach out. Happy to have that conversation. Till then, I'll see you on the next one.